Bank of Canada is holding its key interest rate at 5%. That's holding it steady. The move comes as inflation resumes its downward trend. So what does that mean for our investments? And if we're looking to recover from the losses this past year, Peter Sashecki with Everything Financial joins us now with more. Good morning, Peter. Good to see you.
Good morning, Carrie. Nice to see you.
So let's talk about this interest rate holding steady. This is something that most analysts expected.
They did expect this, and they expect rates to stay the same or even finally start that downward trend, which is long overdue because of inflation being down. The gap is a little bigger than it should be right now. But most reports have it at least out till June of next year, staying level, or the downward trend will start at some point in the near future.
Okay, let's talk about people who have investments, mortgages, maybe they're looking to renew things. What should they be looking at right now? What should they be considering?
Well, let's start with the mortgages, Carrie. Stay, as we've been saying, you and I, for the longest time, stay short term. If inflation keeps going down or level to down, then those lower rates are going to come. So you don't want to lock into something longer. And I hate saying this, but there's been a lot of irresponsibility being reported, not by media, but by banks and mortgage companies the last few days. Like, ooh, you better go 5 years. These rates are going up. There was tons of reports the other day that rates were going to be skyrocketing again today. Like, just fear-mongering and irresponsibility. Take a deep breath. If you're coming up for renewal, stay with that 1 year, maybe two, just to give you that breathing room and treading water until we get those lower rates that are coming in the near future.
Okay, and the rate of inflation is at 3.8%. They want that to be a little bit lower still?
Yes, but it's really about 2.97. The thing is, the government changed how we calculate inflation back in June. So they started adding things that are really being counted twice, and that's a whole other episode. But we're really sitting around 3, which is good. They know this. They know that they've changed how we do it. So we're definitely on the right track, and only about 40% of all those interest rate hikes that we saw in the last 2 years have really taken effect because they take 12 to 15 months. So there's a lot of downward trend still to come from the pain we suffered with interest rates hikes of over a year ago.
Yeah, okay, so a lot of people are keeping an eye on their investments, and with this interest rate holding steady, there's lots to consider there. And, you know, a lot of people have a financial planner that helps them through some of these things. But let's talk about a portfolio manager. What is the difference between a portfolio manager and mutual funds?
Portfolio managers, for one, are a fiduciary, which means they have to do what's in your best interest by law. They also have to disclose every fee, unlike mutual funds. So that's a big advantage for you. And that's the route everyone, and I don't know why, I do know why, but that's the route everyone should be going, because they're the ones who are truly have everything in your best interest. But fiduciary is the main thing, disclosing all fees, which is really important, knowing what you're getting for your money.
So how do you know if you have a good portfolio manager then?
Look at consistency of performance. I mean, look at not a lot of volatility, and look at what they're investing in. Ask them the questions. So basically what we look for a portfolio manager that's investing in meat and potatoes. Does that mean they're investing in groceries, Carrie? No. But they're investing in the basic things you need for life, things that can be consumed, replaced, remanufactured. We have to use those things every day. And those are the things that are not speculative. Those are the things that are kind of, if you want to say this, recession-proof, because everybody needs them. Those are the questions to ask. Nice, basic, and if I dare say, boring investments that are just nice and steady. And the best way to measure your portfolio manager is never, ever in what they make you. This is the best time to analyze it, because the markets are way down. Look at what they're not losing you. Look at how they're conserving your money during this time. When you see a portfolio manager that's not in the red, even though the markets are down about 12 to 15%, you know you've got a good one.
Interesting way to look at it. Okay, Peter Sashecki with Everything Financial. Thanks so much for your insight this morning. Have a great day.
Thanks, Gary. Have a great day.